What's up, Military Millionaires? My name is Alex Felice, and I'm here today with my wonderful co-host, David Pere. He got fired from doing intros. We are here with the legendary Paul Moore. He's going to be here to talk to us about a bunch of different real estate topics. He's a prolific BiggerPockets contributor. He's coming out with a new book called Storing Up Profits, Capitalize on America's Obsession with Stuff by Investing in Self-Storage. I'm very excited to talk about that.
Welcome to the Military Millionaire Podcast, where we teach service members, veterans, and their families how to build wealth through personal finance, entrepreneurship, and real estate investing. I'm your host, David Pere, and together with my co-host, Alex Felice, we're here to be your no BS guides along the most important mission you'll ever embark on, your finances.
Vehicle 1, you're clear to depart friendly lines.
Roger, Vic 1, Oscar Mike. What's up, Military Millionaires? I wanted to briefly talk about a service I offer that a whole lot of people don't seem to know about, and I guess that's a failure on my part for not having discussed it enough. So look, finding a realtor that understands investing and or the VA loan or both is not always the easiest thing in the world. And finding a lender, same thing. So what I have started doing is I've built I have a large network, but I've started to compile it all together finally as a legitimate Excel document driven, location driven list for you guys, essentially. So what it is basically just my way of helping connect you with a realtor or a lender that I know personally and have vetted and talked to and understand that they're not going to screw you. And what I do is, like, for example, I had a market where I had 2 or 3 agents that I all sent the same person as a connection and said, hey man, I trust, I know all of these. Let me know what you think. And they all said the same agent and same thing. So what I've done is if there's multiple agents in the same market, I choose the best one, and that's who I'm going to hook you up with. But the whole point of this is just to help ensure that you get connected to the best agent. So if that is something that you would like, just go to the website, go to FromMilitaryToMillionaire.com/VA-Realtor/ or just reach out to me on Instagram or Facebook, whatever. I'll send you the link, or you can find it on the resources page of the website. But look, all it is a way to help connect you with an agent who's going to hook you up. No, I don't charge a fee for you. No, I don't charge a fee for the agent. It's just a way to hook you guys up. At the end of the day, as a buyer, you're not going to pay for a realtor anyway. So, ta-da, it's magic. You might as well use one. As far as VA lender, I've got a really good one that I work with and know very well. There's several others that are pretty good, and I'll probably try to steer you away from some companies that I just don't think are very reputable or have been very helpful. So, if this is a service that sounds good to you for free 99, then reach out, and if not, then enjoy the show right now.
Paul, welcome to the show.
Hey, it's great to be here, guys. Thank you for having me on.
Absolutely. Why don't you give a little bit of background about how you got into real estate investing? Tell your story.
Okay. Well, I started with an engineering degree, which was my first mistake. And then I got an MBA, went to Ford Motor Company, realized I wasn't really fit for corporate America. So started my own company. We had the good fortune to sell it in 5 years to a publicly traded firm. And I started investing in real estate to protect and grow my own wealth, and started flipping houses. Then I started flipping waterfront lots at a resort area called Smith Mountain Lake. Built some houses, and I learned this amazing lesson. You shouldn't build your own house if you don't know how to tighten the doorknob on a house. That's just something I learned that's free for your audience. Did a small subdivision. And over the years, I was always kind of perplexed. Like, how do these really rich guys get involved in commercial real estate? What do they do? How do I get involved? I wasn't sure where the on-ramp was. But I invested in oil and gas in 2010 in North Dakota during the big Bakken oil boom. And there was a massive housing shortage. I mean, there were like 10,000 people going to towns of 3,000 looking for a place to stay. And so we quickly built a couple multifamily facilities. We operated those as like extended stay hotels. We made a lot of money. My partner went on to build a Hyatt hotel. I decided to stay in multifamily. I ended up writing a book on apartment investing, humbly entitled The Perfect Investment. And we found out that the perfect investment wasn't perfect if you have to way overpay to get it. And so we expanded at that point out into self-storage and mobile home parks, RV parks, some other asset types. And we have, my company has 5 funds managing investments in those spaces.
Wow, that's a lot of funds.
Very impressive. Serial entrepreneur. I love it. Right before we got on the show, though, I want to preface this. You said you want to talk, or you recently gave a talk about why real estate's a boring investment and why that's a good thing. And is that something you'd like to expand on a little bit? Could you talk about that?
Yeah, it's not exactly. So I will say it this way. So I am so glad you asked, Alex, because I was a serial entrepreneur for years. I thought about having a serial entrepreneur business card, and I was proud of that. I should have had a card that said certified shiny object chaser, because that's what I did. And I lost, literally in 2 deals alone, I think I lost millions of dollars because I got distracted. Gary Keller and Jay Papasan, their amazing book, The One Thing, says, they say, if he who chases 2 rabbits catches neither. And so I found out, for years, I thought that investing should give me the same excitement that being an entrepreneur did. But that was a lie. Paul Samuelson is the first economist from the US to win the Nobel Peace Prize. And he said, investing should be boring. It should be like watching paint dry or watching grass grow. He said, if you really want excitement, take $800 and go to Las Vegas. And that was not my attitude. I wanted excitement. And so even when I invested in something and built something and got it up and running, if I got bored, I would turn my attention on something else. So like when we were doing those amazing multifamily properties in North Dakota, it was going well. So I turned my attention to something ground up, like a wireless internet company that was a complete mistake. And so over the years, I found that I was losing money by chasing shiny objects. And I found out, honestly, I would rather be boring. George Soros, I think he's running for Antichrist or something. You shouldn't put that on the air. But seriously, George Soros, did I say that? Seriously.
We don't censor anything here, so we're going to snip that up.
No, I'm going to get in trouble. So no, seriously, George Soros is an amazing investor in his 90s. And he said, if you're having fun, if you're excited, you're probably not investing. Investing should be boring. And so that's the conclusion I've come to. And I found that being, quote, bored allows me to be an expert because I really drill down. I don't chase shiny objects. I stay in my lane. I stay focused. Been doing that for a number of years now. And it's just been a great relief. And it gives me time for my family. It means I'm not always in startup mode, always, in the plane, the jet taking off, using all of its energy to get off the ground. And it's not as exciting as chasing something new, but it is a whole lot more profitable.
I love this. And I think a lot of people are suffering from the shiny object syndrome right now, or they feel like real estate is really exciting. David is the king of shiny object syndrome. He's got his hands in everything. I'm pretty bad myself. I started out real estate, hey, look, buy one of these and sit on it and don't think about it. Really, really, really boring. And I find myself getting caught up in all the excitement because, it's really popular right now. Do you think that the current trend makes things more popular and that it's just part of the cycle, and that when maybe the cycle is over, people will realize that kind of advice? Because Buffett says the same thing, right? Just, buy once and sit on it forever kind of investing seems to be the best wisdom.
Yeah. I tell you what, there's never been a better time, in my opinion, to buy and sit on something for a while. Think about it. We have the lowest interest rates, at least in general, in 5,000 years of Earth history, and that's been documented. We also have something going on that we haven't seen ever before, that to my knowledge, and that is we have high inflation. At the same time, we have these low interest rates. So this combination of low interest rates and high inflation means this: you can lock in for, say, 10 or 12 years, or even 30 in residential real estate. You can lock in your highest payment at a very historically low rate, but yet you can allow inflation to allow you to increase rents and revenue and dramatically increase your wealth. While, in the past, we heard inflation was all bad. Maybe it's not, if you handle it right.
Certainly in a vacuum, I think, in a piece of debt against a real asset, I think inflation is going to be really good. It's the cost of living for everybody else who's not buying real estate where I worry. Right. But I do love that advice. So let me ask you another question. you interact with Bigger Pockets quite a bit.
Mm-hmm.
And I'm going to try to say this diplomatically, but it is not my strong suit. The age demographic of Bigger Pockets is probably a bit younger than you.
I'm younger than I look.
What I mean is that site, and look, I love Bigger Pockets, is mostly what I call the blind leading the blind. It's people who have succeeded for 3 years, teaching people who have just got into it 6 months ago.
Yeah.
And there's not that many outliers, meaning there's not that many people on that site that have been investing since before the crash, which is basically how I determine whether somebody's been good or lucky. If you've only been doing this in an up market, then I don't know if I can trust you or not. But you've certainly been doing it since before this up market. So how does that interaction work? Because there's not many people who have that experience level like you.
Alex, that's a fabulous question. And honestly, in an age when everybody's making huge profits, it's easy to devalue experts. In fact, there's a book called The Death of Expertise, or The Death of Experts. And it says basically, if everybody's benefiting equally, then how can you tell the experts from the amateurs? And on Bigger Pockets, I'm surprised no one's attacked me yet. I call people who weren't even in real estate 5 or 6 years ago, who are now gurus teaching other people. I call them new-rus, new gurus. And I'm trying to coin that phrase, and I'm hoping your amazing audience will help me coin this phrase. But seriously, you can't tell experts from successful or lucky amateurs. And, there's going to come a day, like Buffett said, the rising tide has lifted all these boats, but someday the tide's going to go out, and then we'll see who's skinny dipping.
So I figured this out a few years ago because I read a lot of books, and I really like books. You said the word expert, but that's not really what I'm after. Personally, I'm after wisdom, which maybe we can pick hairs on what the difference is. But certainly this culture and in the economy, people have given up on wisdom, and they're really about the shiny object, right? What can I make, triple % increases on, and how do I get rich tomorrow? And it's all really exciting. And they've sort of dismissed this, what I consider wisdom, which is, investing should be boring. And they've dismissed a lot of the old knowledge, and they've gotten, whatever shiny. And it is a lot of, I personally started in real estate in 2014, which was late in terms of the foreclosure boom. And then I look back, the more I learn, I'm like, you know what? I'm lucky. I don't know how much I know. Let me sit back and learn a lot. And it's just interesting to see. I don't see that many people from before the 2008 crash teaching. I see a lot of people who got into this in 2019 teaching. Yeah. And so I'm glad that you haven't had any troubles interacting with people, but it's good to see some faces with experience.
Yeah, I'll make a comment on that. So I'm in a mastermind with 8 amazing guys, 7 amazing guys than me, but they're actually all like just making millions of dollars. And literally these guys are great, high integrity guys, but only one of them, of the 7, only me and one other guy have been in real estate since before the 2008 crash. It's possible some of them were still in high school then, and they're crushing it, and they're doing all the right things from what I can tell. But I don't know that they've been tested in the fire of what could come. And so to answer your earlier question, Alex, I think being older and speaking from this Buffett type perspective, and hopefully, at least using the wisdom I've learned from Buffett and others, I'm able to speak into the life of these people on Bigger Pockets. And some of them recognize that. And a lot of investors have actually come invested with us because they recognized I was saying something different.
Again, just from my experience, my learning, and you got to understand, like, our demo is geared towards new, young service members or people who just get out of the military, who are trying to turn their finances around. So maybe not a lot of high level investors. Maybe I don't want to, paint too broad a brush, but generally younger people. And, I was young once. I assume you were. Like, we generally take wisdom and it's very easy to negate it. It's very easy to look at it and be like, you don't know anything. I know everything.
Oh, yeah. So easy.
And so what's going to happen to these people, and this is why I really bring this up, because I want people to listen to Paul, because the older I get, the more I'm like, bro, wisdom and experience is worth more than fancy language and shiny objects, like forever. And for our young demo, To hear something like, real estate should be boring, investing should be boring. The turnoff, the ability to, or the instinct to turn that off or say like, that's not for me is probably easy, but man, it's really the most valuable thing is that wisdom and experience, way more than the 0.00% returns that you might get from some speculative thing. But just because you're up 15% in a market that's up 20, that doesn't make you good.
Especially with inflation, when the real value of your money's break even at 15, So, I mean, we haven't seen this happen yet. We got this is a $10 trillion bill from Zimbabwe. I don't think that we're going to
laid around.
Really. I don't think we're going to see that. But, guys, seriously, when Warren Buffett was 69, he was a kid, right? At 69, they were starting to call him senile in 1999. He was laughed at, mocked, marginalized because they said he was senile. He had completely missed the tech boom. And he got up at Sun Valley, Idaho, with his little annual meeting every June of billionaires. And he said, guys, I'd rather invest in Wrigley than in the internet, because I don't know where tech and where the internet will be in 10 years. I do know how people will be chewing gum. I'll continue to be boring. You guys go ahead and have fun. He said, don't forget, though, that in the short run, the stock market is like a voting machine. In the long run, it's like a weighing scale. In the short run, the voting machine just votes for what's popular, what's shiny, what's exciting. And of course, a year and a half later, in March of 2000, the tech bubble burst and Buffett was proved right yet again. And all those people who were, these new billionaires were, delivering pizzas.
Yeah, so fascinating. Speculation versus investing. I really, really, really try to be an investor and never a speculator. It is very difficult. I have a huge ego. I have a lot of friends who are winning and I want to get that FOMO. And it's really easy to be like, I want to get ahead of the next big opportunity rather than say, I want to stay with what is tried and true. My intellectual hero, a guy named Nassim Taleb, he goes, you never take on risk of ruin. And, people who have their it's so interesting. I know people who have their entire portfolios in cryptocurrencies. And then you have guys like Charlie Munger and Warren Buffett who are like, I wish they would just ban it. There's nothing. It's terrible investment. And so I'm like, one of them is right. And, it's okay for Buffett to be wrong. He's been wrong before, but it's very similar to the tech bubble where it's like a lot of speculation, a lot of mania. In 2001, we had just had, we didn't have the tradings on the phones yet, but we had E-Trade had just come out. And so for the first time, somebody could get on the internet and for $6 make a trade. And so the liquidity rushed into the market like never before. And I think we're seeing that same thing with Robinhood and these crypto apps where a kid can get on there with a little bit of money and do micro trades. And so you have all this liquidity and it makes it really, really speculative. I don't want to say bubbles, but potentially bubbles. So it's really interesting times.
It really is. And it's funny you mentioned Nassim because I was actually speaking at an anti-fragile conference in Dallas 2 weeks ago. So
I've read all his books twice. I talk about him every day. He's my hero of heroes.
They're on the bookshelf back there, I think.
They used to be. Next time you go, please invite me. I want to go to his conference in New York, the Real World Risk Institute, but it's like $8,000.
Oh, and just to be clear, it wasn't Nassim's conference. It was somebody using his anti-fragile theme to do their own conference, but it was awesome.
Still probably my people.
Yeah, probably. I think you'd like these guys.
Let's talk about self-storage. I love the title of your book. I love it. I am sort of a anti-consumerist type of, I'm like, I have it's easy to critique America and be like, you guys need all this. You do not need all this stuff, but they're going to buy it anyways. And they're going to store it in Paul's self-storage facilities. And then when the big explosion happens and they downsize their house, they're going to store all that stuff in Paul's storage as well. So it's pretty recession resistant.
Yeah, it really is crazy. I love self-storage for that reason. That's one of many. In good times, people are filling up their Amazon and Walmart carts, and we may be skeptical of this, but it's really happening. And people need a place to store their stuff. In bad times, people are downsizing, or they're getting, they have death, divorce, dislocation, downsizing, and they're, are needing a place to store their stuff. And for a small price, they can store it rather than get rid of it. What happened in COVID? Well, COVID struck, and right away we have thousands, tens of thousands of college students storing their stuff, not sure if they're, going to be coming back when we flatten the curve in 2 weeks. Did that happen? And and then later we have, wholesale mass migration from New York, Chicago, LA, San Francisco to Montana, Utah, Texas, and Florida. And people need a place to store their stuff along the way. And we have restaurants, bars closing, other types of, offices downsizing as people work from home, and people are storing their stuff. And so it really is recession resistant. The thing I love best about self-storage, well, one more thing first is the prices are really inelastic. I mean, think about it. I mean, if I'm renting $1,000 apartment from you, David, and you raise the rent 6%, I might leave rather than pay the extra $60 a month, $720 a year from signing that lease. But with a month-to-month self-storage lease, if you raise my rent, 6%, I'm paying $100. It's going to go to 106. I get irritated, but then I forget about it until the next time you raise it, and it hits my credit card at $113 next time. So people aren't usually going to spend a weekend, rent a U-Haul, get their buddies together to move their junk, their treasures down the street just to save $6 a month. My favorite thing about self-storage is it's extremely fragmented, unlike multifamily. I love multifamily, wrote a book on it, but self-storage, there's 53,000 facilities in the US. That's about the same as Starbucks, Subway, McDonald's combined, but 75% or so are run by independent operators, and 2 of every 3 of those are actually mom and pop operators. They typically don't have the desire, the resources, or the knowledge to improve the asset, drive higher income, and maximize the value for their investors. So acquire, and they don't need to. They've already seen the price of their self-storage facility double in the last 5 years just because the market rise. And so they can be mediocre and be sitting on a very valuable asset. An expert, or a wise operator can walk in, buy that self-storage facility, upgrade it, and create an incredible situation for their investors. And that's the type of deals we like to invest in.
Self-storage has been called the new hotness for a few years now. Is it still fragmented the way it was 6 years ago?
Yeah, it's not as fragmented. I mean, there are institutional buyers and these large regional players like we invest with who are buying these up. And so it's becoming less fragmented every year. And just like, there was a day in my life, you guys might remember when the last World War I veteran died, there was no more on the planet. Well, it's going to be that way with self-storage eventually, but thankfully that day is not today.
I helped a buddy buy one. And David, would you like to speak? It is you're here too.
I am, and I am going to say something for the first time today. So one of the things I love about self-storage is the fact that you can with an apartment, right? We all know about evictions and turnovers and all this other craziness. That's a miserable experience. With self-storage, from what I understand, and I mean, it might be different in different areas, you can auction off, if somebody just leaves it locked and whatever, you can literally make money from the eviction process, which is great. Because I mean, even when I have tenants die, I have to go pay for storage. It's like this unavoidable expense for me. But on the running a self-storage, it's like the one world where you can actually profit on a turnover.
It's amazing. During COVID, you couldn't evict tenants from a lot of apartments, but we could always evict people from self-storage because it wasn't a person you were moving out. And we had the leverage of having their stuff. And so it was pretty easy to get people to pay. And then, like you said, as a last resort, we can auction off their stuff and move on. And so it's really great business in a lot of ways.
Yeah, I love this. You mentioned RV parks too. Have you had much experience with that? That's what I've been moving towards recently.
Guys, RV parks are where self-storage and maybe apartments were 20 or 30 years ago.
David, we need to take that little soundbite
No,
I
you
need you to
can't
give
have
it to me so I can market it for my
Copyrighted.
company. Sorry, Paul. And because we are moving heavy into RVs, we've been doing multifamily, C-class multifamily value add for the last 8 years because it was, a lot of the same things, fragmented, a lot of room for growth, low interest rates, inflation, buys you some rent increases. But now we look and we say we got to pivot because investing is boring, but you do have to pivot when the market tells you to pivot.
Right.
And I think we're going to pivot out of multifamily, and we're looking at self-storage and going, God, Paul Moore has already dominated it. I don't want to compete with a Paul Moore or a lot of these other people, but RV parks, I feel, are really behind that curve, and the RV industry is booming. And so we went off and got 7 parks and got 20 more million in LOI under right now. And for
Seriously?
2020, we are going hard. Yeah, let's
Guys,
talk. If you want to talk
I
about
should-
RV parks, let's
that
go.
is awesome.
Yeah. But I'm glad to hear you say that because that's what we feel. And that's the pitch that I've been doing is RV parks are what multifamily and self-storage was 8 years ago. Fragmented. It's a growing industry and you get a lot of the same benefits where, I own the pad, not the vehicle.
Right. Yeah. It's amazing. I mean, there's so much we could say about this. I'll say this, that we've been interested in RV parks for years. So our company, Wellings Capital, we go out and find expert operators who've been in business, or at least their principals have been since before the Great Recession 14 years ago. And we invest heavily with them and give them the equity they need to grow. Well, we couldn't find anybody in RV parks, guys. I mean, we weren't looking hard the whole time, but for the last few years, we've been very interested. We've been actively investing in mobile home parks. With apartments, you got to spend a lot of time just to figure out who the newroos are and who the real wise guys are, the real wisdom experts. But with RV parks, we didn't even have any choices. We couldn't find anybody who had been doing it systematically with a team, technology, and track record that we wanted to see to invest in RV parks. We did finally find somebody, but 2 of the 3 big companies that were crushing in this arena had already been acquired by Sun Communities. And so there was only one to choose from so far. I hope there's others out there. And if you're out there, get hold of us because we're interested in this whole space. And we think it is incredible runway ahead of it.
Have you heard of Climb Capital?
He said before the recession.
Yeah, but he said he couldn't find anybody.
Oh. I mean, I'm going to jump into it next week, Paul. So let's talk.
Okay, let's talk. Climb Capital?
Climb.
No, I have not.
Oh, okay.
Should I?
Yeah, of course. Yeah.
Here comes
We are the
pitch.
premier RV operators in the Sun Belt.
This is a non-pitch show, Alex.
I agree.
Okay.
Okay. Just teasing. I'm just making yeah.
Let it out. Let it out.
Look, I'm being ridiculous. Can't help myself. Wouldn't want to if I could.
You can still be premier
So-
and new.
So Alex is on a team with a good friend of ours who has done, like he said, C-class multifamily and is now pivoting into and dominating or going to be dominating the RV space. So
Nice.
Alex, if you want to talk about it, I will not bleep you out entirely.
No, it's okay. We're here for Paul. I'm here for you, Paul. This is not about
I'm
me.
here for you guys.
Everybody, yeah, you're a great guest, actually. Everybody else has to deal with me all the time. David, he is so sick of me, so I like to make it about the guest.
Well, anyway, I love RV parks.
Yeah, they're pretty sweet. It's funny. When Alex and the friends on the team started talking about them, I started looking around my market and realized there really aren't any. So there's probably an opportunity there, but I don't know that building an RV park as my first go is going to be what I do. However, I am looking at what was once a mobile home park and is now pretty much one trailer on a bunch of pads. So
Really? Wow.
there's potential. I just don't think it's close enough to the highway to be.
Yeah. Well, I mean, I stayed at one last week that was almost an hour west of Fort Worth. And it was out in the middle of the sticks, guys. And it was, they were crushing it. They put in so they bought it. I don't remember the exact price, but I think, let's say it was like $4 million. They had like an extra 100 or 200 acres with it. They could expand. They put in like a $600,000 lake. They put in like a $200,000 Wibbit. structure. You guys know what Wibbits are? Wibbits are these
imagining
big-
you're not talking about when you huff like brown bags.
No,
It's a whippet.
not at all. That's whippet. No, a whippet. Maybe I'm even saying it wrong. It's a big structure that's like it's anchored down in a lake, and you can actually let kids or adults and kids run up around. They run around it. They dive off. They jump off. There's slides off of it. It's like I don't even know how to spell it, but at any rate,
it looks like a moon bounce on the lake.
Yeah, that's right.
Yeah.
And so
I'm looking at one now. It's interesting. Yeah.
Okay, so this is like a destination park. People would go there. They bring their RV. They pay an extra fee for like a resort fee, just like you do at a nice hotel. It might be $8 per person per day, but that gives them ceramics, and of course they have to buy the ceramics. T-shirt painting, they've got to buy the T-shirts. It gives them moonwalk, putt-putt golf, hay rides, movie theater, the Wibbits. The Wibbits, they charge like $15 per hour to jump on these. They're renting this Wibbit that costs $200,000. They're renting it for $1,000 an hour. Talk about a value add. I mean, just on and on and on. And this park is crushing it. I mean, I just can't believe what a great opportunity this is.
Yeah, so that's what we've been doing is the resort RV parks. Yeah, I thought it was just, you get an RV park, you get a bunch of pads, but it's like, no, we build pools, clubhouses, volleyball courts. We build man-made lakes. You put fish in them. I mean, people go fishing. It's a really interesting. It was new to me too. It was very I didn't think that was a thing, but it is an extremely big thing.
Yeah,
a lot of amenities that go with them, and then still, when you're at the end of the day, you really just own the pad.
Right. Yeah, I mean, especially when you're buying these rural areas. I mean, you guys have certainly seen the bonus depreciation you can get. The paper losses from mobile home parks and RV parks are amazing. Who would have thought?
We're starting to buy little tiny homes on wheels, and we put them on the parks. We rent them out as Airbnb, but they're 100%. They take 100% depreciation.
Nice.
Yeah. So there's so many interesting things you can do.
I mean, think about this. So you got the tiny home, you've got the pad, you might have $80,000 and all that. For $1,200, you put a little dog pen around it on the outside, and you rent that for another 30% on top of the normal daily rate for the dog pen. So it's, $60 extra a day for that. These value adds are pretty amazing.
Yeah.
Wait, I'm starting to sound excited.
I was gonna say this isn't boring enough.
This is
you guys need to chill. You guys should both back out of the RV world, chill. And I will go get excited. You guys can be boring.
Forget about RVs.
It's funny because that whole conversation about speculation and excitement is actually really, really well timed, because I'm looking at a building for the second time today that it's not super boring. I think there's a huge potential, but I mean, I've spent probably 12 hours with city planning, downtown association, building development, all the things this week. And I don't know. It's like, it's a good reminder, another check and balance to be like, okay, how much of this is speculation? How much it's basically an old 20,000 square foot vacant building at a great location downtown that, your retail and office on the first floor, lofts on the second floor, third floor, probably storage in the basement. Cause it's it's a nice dry basement with like 9-foot ceilings, and thinking like, oh, you pretty much put like dog cage style, like storage through it. Cause it's all protected from the outside. I don't know, lots of things, but I haven't figured it out. So, might be a little too exciting for.
Yeah. Well, I mean, it sounds great. Where are you located?
Southwest Missouri.
Okay. Well, what is the difference between investing and speculating?
Hope.
Hope. Yeah, there you go.
I mean, so what is it? Who is it? Who says hopium? I forget who it.
Hopium. Yeah, I don't know who that is, but I view it as this. I used to think wealth was, mansion, nice car, boat, lake house, all that. But I now view it as wealth. True wealth is having assets that produce cash flow. And so investing should be in assets, I would think, assets that produce cash flow. If they produce appreciation as well, that's great. So I view investing as, having a place where your principal is generally safe and you've got a chance to make a return. Speculating is when your principal is not at all safe and you've got a chance to make a return. And some speculation is fine, but just know the difference when you're doing it, because investing will win in the end.
Yep. When I learned real estate investing in 2013, I was the overall message, the overwhelming message that I got from the 2008 crash was always buy for cash flow. Appreciation is a bonus. That was like, the gist of, the people who survived versus the people who got crushed.
Yeah.
And that's what I learned. And that's what I did from day one. I was like, this thing has to cash flow day one. It has to cash flow positively day one. And if it goes up in value, then gravy. Now I feel like people are going, well, I'll buy it now and the inflation will make my property go up in value. It'll make the rents go up in value and it'll be worth XYZ in the future. We're pretty sure inflation's here, but we're not really sure how it's going to affect things positively or negatively and by how much. Is this the same problem that people had in 2006? The real estate will only go up. I mean, I know the circumstances aren't different, but mindset wise.
You're right. The circumstances are different, but mindset wise, I mean, we heard stuff like everybody needs a place to live and they're not making any more land. And what was his name? I'm forgetting his name right now. I'll think of it in a minute. The Federal Treasury Secretary, he said there has never been a drop in real estate prices, a sustained drop. And at the same time,
Geithner.
Who?
Timothy Geithner, I believe.
Geithner, that might have been the Treasury Secretary. I might have been thinking of a different guy. But the guy I'm thinking of, his brother at the same time, Hank Paulson. John Paulson, his brother, if I've got the name straight, was actually shorting the housing market, getting ready to make $2 billion or whatever, while he was saying, and I'm not saying there was a conspiracy, they just had different opinions apparently, but who knows? But at any rate, he's saying there's never been a sustained drop in housing prices. And of course, they were teetering right on the edge of it. And his brother knew that and made billions of dollars in the process.
Yeah, the government is in an interesting position because they have there's an interesting mechanism with government dialogue where if they say things will go up and things are great, then maybe it might go up and maybe it'll be great. But it really is irrelevant. But if they say things will go down, then everybody freaks out and it does in fact go down. So they're in a really precarious position. So anybody that talks about high level, you mentioned the word experts before, anybody who's like an expert, especially in government roles or something like this, they always have to say things are good. You can go and find a quote from a Federal Reserve chairman before every crash and he'll say, everything's fine, don't worry about it. And 2 weeks later, inevitably there'll be an explosion. Right. So Well, to back to my original question, do you think, I wasn't paying attention before in 2006 to like just, your anecdotal feel of how people are acting. Is it mania similar?
Yeah, it's very similar. I was in the residential realm at the time, so I wasn't really privy to the commercial world, but yeah, very similar. There was this sense of, Rod Cleef. He was buying stuff all over Florida. I think he said his net worth went up 30 million in 2006 and then dropped by 50 million in 2007 or 8. I can't remember. And it was like, he was just leveraging on top of leverage to buy and buy and buy because stuff was always going up. It didn't have to cash flow. It didn't matter. And so there was a sense of that. And that was Rod's own story. I'm not saying anything bad about him. He told me that on my podcast. Did I tell you guys I had a podcast called How to Lose Money? I was the host of that for 4 years, where we interviewed 238 people about chasing shiny objects, how they lost money, lost time, lost relationships on the way to their eventual success. And we saw a lot of that.
When did that air?
2016 to 2020.
Is it still live? Can I go find it?
You can go find it. Yeah, it's on Apple, iTunes, Stitcher, all that stuff. But How to
I
Lose
love
Money
that.
podcast. Yeah,
He ran out
lot of pain.
of subjects and thought, we'll wait like 3 years and we'll have a whole bunch more
Yeah.
people to interview.
yeah, yeah. Well, How to Lose Money 2 starting in 2024.
Yeah, in 2020, everything started booming. So you got to come back. Yeah,
Yeah,
you got to get
right.
round 2. I love that.
Yeah.
How do you guys feel about? I know we don't generally speculate on this, but we're kind of in the subject. So how do you guys feel about the market going forward? I mean,
I was just answering that question right before our call with somebody with a large investor. And I said, it's really possible, though there's a lot of speculation going on and a lot of people who are newbies or amateurs who are just getting lucky time after time. It's possible that inflation will allow them to continue to succeed, even if they're not really doing things right. And so, I mean, let's face it, if cap rates go from 4% up to 5%, I just wrote an article in Bigger Pockets that came out like yesterday. It says why you need to increase rents 33% just to break even. That was irritating, wasn't it? And I basically said, look, if you go from a 4 to a 5% cap rate, you just lost 25% of your value. You need to increase your revenue, your net operating income 33% just to break even. And even if that math doesn't make sense to you, just say 25%. It's hard to increase your rents and your revenue 25% or 33% when things are crumbling. Like imagine middle of 2008 or 2009. It would be really hard to increase your rent, your revenue 25%. It's quite the contrary, in fact. So the point of it was cap rate decompression could crush a lot of people. But I will say it's possible inflation will be their rescue because it'll continue to allow the rent and therefore the net operating income to continue rising even while the cap rates expand.
Yeah, the thing that's
I just wanted to add that. Sorry, David. Thank you. The inflation thing is funny because everybody sees it as values going up, but there's a difference between value going up and price going up. I mean,
That's right.
The things are getting more expensive and people go, well, my house is going up in value. And I'm like, yeah, but inflation literally is the increase in money supply, which means the value goes down. So, or the buying power goes down. So you might have more rent and you might have a higher income house or a valued house, but you're actually poorer in terms of buying power. So trying to get it. So right now, if you're buying that skinny deal, even though inflation might save you in terms of, it might save you in some ways, you come out of the end, a overall like less percentage returns. Your returns are lower than they would. Well, how do I say it? Then if you had bought a good deal, I mean, it might buy you out of poverty, but it's not going to buy you out of, the prices are all going to look higher, but you're going to have less buying power. Or
that's exactly right.
Yeah.
They call it like nominal. Your nominal profit would be your profit in name only, which is technically what nominal means, versus your actual or your real profit was the word I wanted to use, which is, where your buying power actually went. My son buys and sells large pieces of farmland or timberland, like mountaintop land. And he might talk to somebody who said, yeah, I bought this property for $100,000 in 1976. Now it's worth $500,000. Pretty good deal, huh? And I'm thinking, no, not at all. I mean, because his, nominal profit was huge. His real profit was, I honestly imagine it was probably a loss at that number, especially compared to the opportunity cost of putting in something that's making 8%.
Especially once you pay taxes on the capital gains that you're still going to get to pay on that.
That's right.
One of the things I've been trying to figure out. So I try to look less at inflation. I view it, long-term fixed rate, low interest debt. I think against inflation, like numerically, that's probably good. But I'm trying to think less in terms of inflation and more in just the supply and demand, the inventory, that side of things with the market. It's like, well, if houses are just flying off the shelves and the inventory is still 20% of what it was 2 years ago, my gut says that that's a good thing, regardless of inflation and interest rates and all this thing. But what I've been trying to wrestle with is figuring out like, where's the plateau? And what I mean by that is in every crash, it's always a stair step. And so what I would love to try to figure out in the crystal ball is like, okay, well, if this continues for 3 years and then it crashes, does it crash back to price now, or does it crash back to price 4 years ago? Because that would make a huge difference. It's like, well, it's going to come back down at some point, but I don't know if I'm at the top and it's about to drop 30% out from under me, or if it's going to go up 30% and then drop 20% and I'm still, that's the fun game.
Yeah, one of my favorite books is Howard Marks, Mastering the Market Cycle. And in that book, he says, it's impossible to predict when the market will turn. All we can do is act responsibly for where we are in the market today. And so that's what I think, these really good investors, the kind that we like to invest with, are doing versus these lucky amateurs who are just buying anything they can get.
Well, that sets up a great next and probably towards the end question. What do you view as acting responsibly right now? What are you guys looking for?
Well, I love that question. I've written a lot about this on my company blog and on the Bigger Pockets blog. Acting responsible to me is finding assets that are very fragmented. And what I mean is that the current ownership is a fragmented ownership base, and then buying at full price, if necessary, from them, and then doing significant modifications to dramatically increase the revenue, therefore the net operating income. So regardless of what happens to cap rate, you're outrunning it. That was a long run-on sentence. Here's what I mean. If you can buy, so Michelangelo was the greatest, most famous sculptor of all time. He said, when I look at a piece of marble, I don't see marble, I see an angel inside. I need to chip away all the excess material to get that angel out. In the same way, a great operator can look at a property like an RV park, self-storage, mobile home park, and see this incredible intrinsic value. Buffett calls it, buying a company way below its potential value, what it should have. And then so buying a property like that. So in the value equation, the numerator outruns the denominator. Here's what I mean. The value in commercial real estate is the net operating income. That's the numerator, divided by the cap rate. That's the denominator. The cap rate is the rate of return that somebody would expect for an asset like this, in a time like this, in a location like this. And so the cap rate might be 4 or 5%. Well, if it expands, that means it goes up to 6%. The value of the property drops by, let's just round number and say, by 20%. Well, you want to get a property where you can significantly increase the numerator, the net operating income. It's basically called forced appreciation, where you can do things to force the appreciation and way outrun the denominator. To me, that is acting responsibly. Quick example, my company invested in a mobile home park in Louisville, Kentucky. The owner hadn't been there in over 5 years. The costs were bloated. The occupancy was down. The rents hadn't been raised in 5 years at least, from what we understand. And he bought it. He paid the owner what she considered an amazing amount of money, I think, $7.1 million. Well, he went in and he did about 5 things that actually helped grow the revenue of the park, helped make the park, a much better place to live, et cetera. And in 10 months, he sold that park. He bought it for $7.1 million. That was half debt, half equity. He sold it for $15 million in 10 months. And so that was about a 347% return on equity in just 10 months. And the point of that is, even if the market would have went against him significantly during that time, even if interest rates would have went up, even if things would have gone south, he would have still been way ahead of the curve. That's acting responsibly.
I love it. That's a great answer. I mean, and I think that's the right.
I want to ask a bunch more questions, but we got a hard stop time of 4 minutes left. So, David,
I can go a few more.
Can you? Well, still okay, but these questions are gonna take a while. So, David, can you hit him with our outro? All the questions I had left were going to be really difficult. So
maybe we should do a second show.
Absolutely. I love this. Yeah.
I'm down. Hit it with what do you ask me to hit people with?
So at the end of every show, we ask people the same three questions. We've been doing it for 2.5 years.
That part.
If you need me to send you an email with what they are, you let me know.
Oh my God, you terrible person. Sorry. I was double checking mine because I thought I had a 3:00 hard stop, which I didn't. So, all right. I guess the first and most important one is, and we haven't asked the other two in probably like 50 episodes. So I don't know what you're talking about. Really, the question is, where can people get a hold of you if and when they want to find out more about you and invest with you?
Yeah. So I spent years, like I said, trying to figure out how to get into commercial real estate. So I've created a free course people can go through. It's just 5 days to learn how to invest in commercial real estate. I've also got special reports on self-storage and mobile home parks and other investments at my website. It's wellingscapital.com. That's WELLINGS, wellingscapital.com/resources. And that'll get you the free stuff.
Paul, I bought your book on Amazon while we were talking, by the way. So what I'm going to do is when I get it, I'm going to send it to you so you can sign it and then you can mail it back to me.
Awesome. Well, I can just mail you one and you can give that other one away.
Oh, yeah, we can do that. That sounds good.
Okay. Get me your mailing address and email.
All right, cool.
Both of you.
Hey, this was fantastic. I'm incredibly grateful for your time.
Yeah, no, this was a lot of fun.
I enjoyed it too. You guys are a lot of fun.
Oh,
Yeah. He's talking to me, David. He needs me.
pain in the ass. Yeah, I mean, of course he means you. Everything's about, well, no. So this is good because you are more experienced in the market. So there's a lot of good insight here. I don't want to throw around
thank you.
words
It was a real honor to be here, man.
But not a Nuru.
You're a Nuru. Okay, great.
I said you're not a Nuru.
Oh, okay. I thought you said you're a Nuru. I thought.
I mean, technically, by your definition, I'm a Nuru, but you know.
Hey, I want to thank you guys. At times like this in our country, seriously, we really, really appreciate our veterans, and I want to thank you and your audience. I mean, it means the world to people like me, who my dad fought in World War II, but I didn't have to serve and didn't have the opportunity, I should say. And thank you so much for what you did for our country.
Thank you very much. We appreciate it.
Yeah, we're out here trying to make sure our service members, when they're done with whatever the political nonsense of the day is, that they're set up for life and not broke and stressed out from it.
Good. Fantastic.
Thanks for being an awesome guest, Paul.
Thanks, Paul.
Thanks, guys.
Thank you for listening to another episode about my journey from military to millionaire. If you liked it, be sure to visit FromMilitaryToMillionaire.com/podcast to subscribe to future podcasts. While you're there, we'd love for you to rate the show, give us a review on iTunes. Now get out there and take action.